SpaceX is now worth over $400 billion. OpenAI just ran a secondary sale at a $500 billion valuation. Stripe, the payment processor you probably use every day, is valued at $91 billion. And here's the kicker. You can't invest in any of them, not a single share. Why? Because they're choosing to stay private. And they're not alone. The companies building the future, the ones with the explosive growth, the revolutionary technology, the valuations that make your head spin, they're all staying behind closed doors. But here's what nobody's telling you. This isn't about strategic flexibility or avoiding market volatility. There's a much darker reason these unicorns are hiding from public markets. And when you understand it, the entire venture capital ecosystem starts to look very different. Today, we're pulling back the curtain on the greatest wealth concentration scheme in modern finance. Stick around because what I'm about to show you will change how you think about startup valuations forever. In the opening of the episode, I mentioned Stripe, OpenAI, and SpaceX as just three examples of companies that are hugely valuable in the private markets that are staying private, but they're not alone. ByteDance, Shein, Databricks, Anthropic, XAI, and even Revolut are all staying private. So it begs the question, why is this happening? Well, there are legitimate reasons and there are BS reasons. So what are the legitimate reasons? Well, let's start with the main one, which is they don't have to go private, at least not to finance their companies. You have to remember most companies will go public so that they get access to a larger pool of capital, which is represented by public markets. So anything that you would buy as a publicly traded share, like in a Johnson & Johnson or an Apple or an Amazon even, those are all public equities on a public market, and that market is massive. So a company will decide to go public to effectively offer little tiny pieces of their company, equity in their company, in the form of shares. It's been going on forever. But if you don't need to go public to raise money that then finances the growth of your business, there's not a lot of incentive to do it right now. We're seeing tons of private investors, private capital coming into these hugely valuable companies, and it's not uncommon to see $1 billion raised in the private markets in a single fundraise. By staying private, they get to avoid the regulatory kind of oversight and compliance, disclosure burdens that come with being a public company. You have to report every single quarter in great detail the financial health of your company, the growth or the lack of growth. You have to get into unbelievable amounts of minutia. You often have earnings calls or investors calls. You have this mountain of paperwork. And then you have to do it every 3 months. It's a lot of work. It costs a lot of money. It's incredibly time consuming. And sometimes there are unintended consequences, which is you have to disclose how you're doing well. And some of the people that get to see that might be competitors. So here are some of the BS reasons you get from founders in these privately held companies. They'll cite market volatility and timing concerns around an IPO. This is an excuse. It's a crap excuse at that, because there is no perfect timing for an IPO. Anything can change at any point in time. Your regulatory environment could change. The market conditions could change. The global economy could change. Interest in your technology could change. A competitor comes along who's better at doing whatever it is that you're doing and slowly takes away your market share. There's no perfect timing for an IPO. It's just an excuse to delay it or to simply ignore the process or the potential of an IPO. There's also just the flat BS argument around long-term strategic flexibility. They really just don't want the oversight and the scrutiny required by public markets. Again, it sounds good on paper that, I want to be able to move the company in the way that is best for our employees and for our customers. It's all garbage, really. It's just you don't want somebody looking over your shoulder and making sure that you're running business above board, that you're doing what you say you're going to do, and that you're a good steward of your shareholders' capital and your shareholders' equity. I hope you're enjoying the content, and if you are, please consider subscribing to the channel. Back to the episode. And I alluded to this before, but the real reason that most of these companies are staying private is they can't replicate their private valuations under public market conditions and scrutiny. I did a podcast not long ago which speculated I don't see a path for OpenAI, to name a specific company, to go public. Certainly not at anything that would represent a normal escalation of the valuation already being set in the private markets. That's a fancy way of saying if you're worth $500 billion right now, which is 33 times forward-looking earnings for 2025, how in the world are you going to go public at a higher valuation than that? And by the time they raise money again privately or they structure some sort of financing deal, they're going to want to claim that they're closer to $1 trillion in valuation. And again, I don't know too many companies that have ever gone public with $1 trillion market cap. It's just not something that happens. Could it happen? Absolutely. Could we be seeing a huge shift in this? Will the public markets encourage them to do that just so they get a chance to invest in OpenAI? Absolutely. All of those chips are on the table. All of that is a possibility, but it doesn't seem likely and certainly feels like it's going to come with some friction. Now, for all of you stands out there that want to jump down my throat in the comments using Palantir and Tesla as examples of public companies that have these huge multiples on earnings, those should be seen as outliers, not examples. The Palantir one specifically makes absolutely no sense. It's conservatively 200 times future-looking earnings or forward-looking earnings for 2025, when better than half of its revenue literally comes from one customer, which is the US government. That's a fragile business model and a hell of a premium to be paying for a company that has that much concentration in a single customer. And Tesla's never made sense. I think anybody who can look at it objectively, who's not a big Elon fan or a Tesla fan, can take a step back and look at it and go, there is no reason why the market cap of this company is more than the next three biggest car companies combined. They don't hit their marks. They don't hit their deadlines. They're woefully behind on full autonomous self-driving. Their taxi service, their driverless taxis, not doing so hot. And despite what Cathie Wood would tell you, it's just not worth what it trades for. Don't benchmark off those things. Those are exceptions. Those are not the rule. Chime, Figma, and Klarna, they all saw substantial valuation corrections after going public. Once investors got a chance to really look at the business model and understand their financials, because now that they're public, they have access to the information that they may not have had before, whether it was through the S1 or subsequent quarterly filings. Sometimes those companies will signal to the market ahead of a quarterly report to let them know, hey, things aren't going great, or maybe they're going better than expected. Now that investors can see these business models for what they truly are and get the detail around their business models, they're not holding up to that scrutiny, at least from a valuation standpoint. So everything I said at the beginning of this episode about those valuations just not being tethered to reality from the private markets going public, those are three examples right there. So what are the downsides to the market when it comes to these companies staying private? Well, there is an ongoing concentration of investment capital in a handful of these wildly valuable private companies. In simplest term, you have investors putting a lot of money into only a couple of companies, and then that investment is going to stay illiquid, meaning they can't get their money back for a real period of time because they aren't public. If I bought 1,000 shares of Apple today, 3 hours later, I could sell those same 1,000 shares of Apple to buy something else, or to hopefully make a profit, or to reallocate that capital somewhere else, just take it off the table, whatever I wanted to do. But the market allows you to buy and sell easily. So those investments are far more liquid than these private investments, which are highly illiquid. And that illiquidity limits new investment or additional investment in other startups, in other emerging companies. It doesn't allow the recycling of capital and capital gains back into the market from investors who have been able to make money and then sell their stake and then take some of that capital that they've gained and then put it back into a new startup or to a different investment, even a public investment. And overall, that limits the risk mitigation that a lot of these investors want to do, meaning maybe they have this huge investment in OpenAI. It's going to be illiquid for a while. It's not necessarily a volatile stock because it's not public, but who knows what the valuation is going to be, but I have a lot of chips on that table. So in order to mitigate my risk, I might go and take some of the liquidity I have and put it in something that's much more stable. Maybe it is a publicly traded stock. Maybe it is a bond. Maybe it is some sort of debt, structured debt instrument, whatever the case may be. Those liquidity constraints and longer investment durations for investors just kind of chokes everything and makes everything move slower and a little bit more lethargic. That's not good for markets. Markets tend to move on activity. They move on volume. And ultimately, this eliminates retail and small investors from participating in these high growth periods for an OpenAI, for a SpaceX, for an XAI. You just don't have access to it. You can't buy in. You're too small. You're not an LP in one of these mega funds. You're not a high net worth individual that's playing in these hedge funds or participating in these hedge funds. So we talked about the market downsides, but what about the company downsides? Like, what's the bad side of this for the company that's deciding to stay private? Well, over time, private investors can gain control or at least kind of overweighted influence inside the company. They're going to have real stakes in these companies. They're going to put a lot of money in there, and they're going to expect a seat at the table, whether it's an actual board seat or it's certainly at least the CEO and founder of the company is going to return their phone call when they have an idea at 9:30 at night on a Tuesday about how the company should structure its workforce. And then they can form these little cabals among the different investors or can be formed on the board depending on how the governance is structured. What I'm saying is investors can kind of gang up together and really force the company to do things it wouldn't do unless those investors were pressuring them to do that. That's much less likely to happen in public markets because those shares are spread across so many more investors. It's hard for any small group or any individual investor to have a big enough stake in those companies to be afforded that kind of influence over the company's decision-making, strategy, etc. As wealthy as the private markets are, public markets still represent a much larger opportunity for capital and funding. There's just a question of what happens when there's no more interest in investing privately at some of these sky-high valuations. At some point, investors look at this and go, well, what happens if it doesn't keep doubling in valuation or it doesn't keep going up quarter over quarter, 15% or 20%. What if that starts to slow down to 7% or 3% a quarter or just goes flat? If I bought in and it doesn't keep going up, or I bought in at a certain amount, it doesn't keep going up, guess what? That's not a good investment for me. And then on top of that, it's illiquid. So at what point in time does the money just not make any sense? Or I should say the valuations don't make any sense for investors to keep plowing money into it. And there's a little bit of evidence, maybe a canary in the coal mine that we're already seeing, and we saw it recently with this OpenAI and NVIDIA deal, and then ultimately AMD and OpenAI, and then NVIDIA and XAI, where they're coming in different flavors and there's nuance to all of it. But basically what's happening is NVIDIA is investing a certain amount of money, potentially billions of dollars, into companies like OpenAI for equity in that company with the expectation, and in some cases, the commitment from OpenAI or from that company to then invest that same amount of money, dollar for dollar over time, in buying back compute from NVIDIA. So whether that's they're buying chips or they're just leasing chips in a data center, whatever the case may be, NVIDIA is literally handing them billions of dollars, and then the company is going back and spending the same amount of money back to NVIDIA to buy compute. This weird circular financing may be a signal that the private fundraising is starting to get a little more difficult, or they're starting to feel a little friction going to investors and saying, I think $500 billion is fair for a company that is claiming 33 times, valuation 33 times of future earnings, future revenues. And lastly, public companies often find it easier to get non-equity-based financing and banking relationships, revolving credit lines, credit warehousing with those banks because they can use their public securities to collateralize that debt or that against that loan. And that isn't something that private equity can do, at least certainly not as easily, and it's just not as readily available. And there's also an impact on investors and employees. Again, we talk about those longer investment durations, the longer periods of time where that equity is illiquid. You can't do anything with it. And when your only meaningful path to liquidity is the secondary markets and those secondary transactions, if you're not familiar with that, it's kind of what it sounds like, which is maybe I hold 100 shares in OpenAI and I find that somebody else would like to buy my 100 shares, again, private equity shares in OpenAI, and they make me an offer that is 30% more than I paid for them or 100% more than I paid for them. I can sell that to another person or another entity for whatever they're willing to pay me for it. That's a secondary transaction. That's what's happening right now. OpenAI just did a secondary sales transaction where they allowed early employees and former employees to sell up to a certain amount of total shares at a $500 billion valuation. So they were able to get some liquidity from their shares. But understand, OpenAI had to allow them to do that. A lot of those shares are restricted, meaning you cannot just sell them whenever you want. You can't just sell them when somebody comes to you and offers you, a big enough check to do it. That's particularly problematic, not as much for investors because typically they structure their investment in a way that gives them access to at least the majority of their position, the majority of their equity is available to be sold in secondary transactions. It's just part of the purchase agreement. But that's not usually the case for employees. Employees are usually restricted. You'll see it all the time, actually post-IPO, where officers, employees, major shareholders in the company aren't allowed to sell their shares for some period of time. It's usually called a lockup, meaning you have to wait months, maybe even a year before you're allowed to start selling those. In some cases, it's structured in a way where you can take up to 2% of your equity and you can sell that immediately at the IPO, but the rest of it is restricted. And over time, you can start to sell more of it. But right now, that seems to be the primary way of generating liquidity in these private investments that frankly hasn't existed before. Now, merger and acquisition activity is another path to liquidity, and it probably is possible for any of these private companies that are worth $100 billion or less. But once you get much farther north of $100 billion, the population of companies in the world that either have access to the capital, can do some sort of stock swap, or even just raise money to finance a deal of that size is incredibly small. There's just not that many companies that can figure out how to foot the bill for a $500 billion company. So what happens next? I think there are three kind of main ways this could go. The first is that this investment concentration continues around the most valuable private companies. I think liquidity continues to suffer and really nothing changes at all. Public markets may become increasingly lethargic as the NASDAQ, S&P fails to attract new high-growth stocks, and maybe it forces investors back into early-stage private investments or even later stage, mid-stage private investments looking for better returns because there's just not much happening in those public markets. And then maybe we see some smaller private companies go public with reasonable valuations. Maybe they take the public capital. Maybe they deal with the public scrutiny and all the compliance issues and all the reporting issues. And that allows them to start competing in a meaningful way with their contemporaries who are staying private. I think the third scenario, the one I just said, is the most likely if the Fed starts to ease some of the requirements around regulation. We're already seeing examples of this, including limiting quarterly reporting to like semi-annual or twice a year. So this idea being that you don't have to do it every quarter because we know it's hard, we know it's expensive, and we know you feel it's a distraction from working in the business and we're actually doing the work needed to grow and create even more shareholder value. So to summarize, here's where we are. The most valuable companies in the world are staying private because they can't defend their valuations under public scrutiny. They're not avoiding IPOs because of paperwork or market timing. They're avoiding the moment when real investors with real money demand real answers. But here's the thing, this isn't sustainable. Eventually, these companies run out of private investors willing to write checks at insane multiples. When you're already valued at 33 times future revenue, who's left to buy in? We're already seeing the cracks. OpenAI trading equity for compute with NVIDIA and AMD. That's not a partnership, that's a fundraising problem dressed up as strategy. This game of financial chicken only ends one of two ways. Either these companies go public and face reality, or they stay private and trade hands among high net worth individuals and secondary funds, while alpha slowly slips every time that equity changes hands. The question isn't if this changes, it's who gets caught holding the bag when it does. What do you think? Can these valuations survive daylight? Let me know in the comments. Thanks for checking out this episode. As always, like, comment, and subscribe, and we'll see you next time.